Hello, my name's Dan Wigley, and for my API project, I've chosen to use the Vantage API. This API provides real-time market data through the use of their API. This could be stock data, cryptocurrency data, foreign exchange data, and many more, including technical indicators. It's commonly used for quantitative investing and machine learning for investors, students, educators, whatever it may be. I was personally motivated to use this API because of my interest in the financial markets investing and my experience in the financial services industry itself. For a quick introduction to what kind of data analysis I'm going to get into, I will use daily time series data collected from Vantage API to perform statistical analysis on one value stock, Verizon, and one growth stock, Amazon, on the past 100 days. A value stock is believed to be undervalued by the market and typically cheaper. Growth stock is believed to deliver better than market returns given their high growth. Some questions that I hope to answer given the time are: which direction is each stock price trending? Which investment provides a higher return? Which stock has higher volatility or risk? What is the 95% confidence interval for daily return? What is the probability of having a specific closing price on any given day? Does the past close price impact the future close price? And how does trading volume impact share price? I'll provide a brief introduction to collecting data with the GET method. I use the base URL, which is provided on the screen, with the params function overview, symbol AMZN for Amazon, and the API key. It's a token, which was previously saved. After using the request.get, I formatted the response in JSON format to understand how the data was presented. And as you can see, there's a key with a value for each one. So how did I get these pandas data frames, including 5 value stocks and 5 growth stocks? I created a function to pull the relevant data from the API call, then loop through the list of tickers where I called the function, and then appended this to an empty list. From here, I was able to create a pandas data frame. I did this for the growth tickers as well, as you can see. This use of the API is just to familiarize some differences in value and growth stocks, because I'll get into the analysis further in this video. But as you can see, just some quick things. The PE ratios are much higher for the growth stocks because people are more willing to pay a higher price today for the high growth in the future. And as you can see, the average quarterly revenue growth for year over year for the value stocks is much lower than the growth stocks. And this is just due to the high growth of the growth stocks. For time series data, which I will be using for the rest of the video, basically the same way that I got the company overview, but this time just using the time series daily function. From here, you can see the response that's given after the API call. And then after looking at the response, I was able to just get the time series daily key and data from that, which provides the open, high, low, close, and volume for each day. After cleaning up the data, typecasting to floats, I was able to create a pandas data frame for each Verizon and Amazon, as you can see. For trend direction, over the past 100 days, Verizon's close price has been trending downward. As you can see, the 5-day weighted moving average line is very accurate in forecasting which direction the stock price is trending. The weighted moving average line stays below the close price while the price is going down, which can be an indicator for investors to sell because the close price is above the weighted moving average. Amazon's close price plotted over the past 100 days has been much more up and down, as you can see, or volatile. For this, the weighted moving average is hard to use as an indicator for where the price is trending. Which investment provides a higher return and which is safer? Verizon's daily returns remain closer to zero, while Amazon's move further away from zero. This could be due to their high growth and volatility. Verizon's distribution is skewed to the left because of their negative price drift, as you saw on the slide before. And Amazon's is also skewed to the left but I believe this could be due to the outlier of just below -8% daily return. And I will show some box plots in the next slide, which will help further understand this distribution. So for Verizon, the mean is very close to 0, but it's negative, which reflects that negative price drift. Standard deviation for their daily returns is relatively low, which shows that Verizon's a safer investment, and their skewness is also negative, which is due to that negative price drift. For Amazon, the mean is also negative and close to 0. This could be due to the outlier of -8% and the volatility throughout the past 100 days. Standard deviation is higher than Verizon's, and that makes sense because the volatility and the fact that it's a high growth stock, there's more risk, but there's a higher upside. And the skewness is also highly to the left, given that outlier just below -8%, as you can see. Which stock is more volatile, and is there volatility clustering? As you can see, Amazon is much more volatile in this graph, as plotted the daily returns in a line plot over the past 100 days. You can see that Amazon's is much more up and down, and the values are much higher. As you can see towards the end, that large drop down where that outlier is just below -8%, and then back up to 0 the next day. So what is volatility clustering? This is the observation that a large change is followed by more large changes. As you can see, about 10 days in, you can see that the price drops to almost -3%, and then back up to 4%, and then back down to almost 0%. So there is volatility clustering within Amazon, as the large changes in returns cause more large changes in returns, and it never really bottoms out. It's constantly up and down. The 95% confidence interval for daily return on any day in the last 100. So Verizon's 95% confidence interval is from -0.15% to -0.05% roughly, which is not great for investors if you would be confident that the daily return would be negative, given that the upper bound is also negative. But for Amazon, their upper bound is positive, which gives hope to investors that they would have a positive return on any day. Does the past close price impact the future close price? So I performed 99 autocorrelations for the past 100 days for Verizon and Amazon. Amazon closing price is fairly has a positive correlation with the past price. So the past price does impact the future price. This could be due just to that constant negative drift, as you saw in the time series plot. But for Amazon, not as much due to the volatility, but the autocorrelations oscillate almost every 20 days. And this could be due to some company news or just any news that could positively or negatively impact stock price, along with just large sell-offs, which are very common in the markets. The 95% confidence interval for trading volume. The Verizon's confidence interval is much larger, and the trading volume is much larger given their mean. And this could be due to their just cheaper price. More shares can be bought and sold per day. And Amazon's is much lower due to just their expensive price, and not as many shares are bought daily because it's a large price to pay for just per share. But for Amazon, or for Verizon, you could buy a lot more at once. So correlation between the close price and trading volume. Here you can see that the volume and close for Verizon have a strong negative correlation, which means that as the volume increases, it's possible that the close price is decreasing, as this could be investors that are flocking to sell their shares because of bad news. But for Amazon, the correlation is not as strong and it's positive, which means that possibly more trading volume could lead to higher close price, which could be good news that investors are flocking to buy Amazon.